All right, good morning, everybody. Welcome back to my favorite day of the week because it's another episode of the Tim and Tim Show, Tuesdays at 10 a.m. Eastern Time. Tim, how you doing today, man?
Not bad. Can't complain.
Can't
Getting ready to.
complain.
Well, nobody listens to me when I do.
Hey, well,
Like,
actually, that's not true because everyone is listening on this call today. So, and
yeah, but
and
nobody
every
wants to.
we,
Nobody tuned
we've
in
been
to hear
doing
me,
this for almost
bitch.
3 years now. Everyone's been hearing you're a can't complain.
Yeah, nobody tuned in to listen to me bitch about stuff, so I'm
Yeah.
not going to give it to them.
Yeah. Well, so a lot of conversations we've had coming up lately of when is a good time to sell. And my personal opinion about when a good time to sell is going to come down to your opportunity cost. And I don't think it's easy for anyone to put an opportunity cost on somebody else's situation. We can always listen to what your perspective is and we can hear what your deal flow looks like and have an understanding of what you're trying to accomplish, but ultimately it comes down to do you have somewhere else to put the money? Uh Tim and I'm not going to speak for Tim Vest here, but my personal investment thesis has been people in stocks always reach a certain level of returns and they're good with taking gains and moving their money into a new stock. And why shouldn't you do the same thing in real estate? And if you can pocket some cash on a successful deal and make some money, why wouldn't you do that? I don't think that it's more of a rhetorical question because I don't think anybody can answer that for somebody else. It always has to be something that you're searching for internally of, is this a good enough? Am I going to be able to sleep at night on this number? Are my investors going to be happy with these numbers? And if I sell this, am I going to have somewhere else to put the money? I think that's
Yeah,
I think the one of the major driving factors of why we look at selling assets that we own.
yeah, and it's one of those things. It's like, Tim, you and I talk about it all the time. It's like, do I feel it, right? Like, do I feel it? Because and what I'm talking about, folks, is, and good morning, Dennis, by the way. What I'm talking about, is sometimes we own a lot of assets, but we really don't feel their impact other than they're causing work for us, right?
Mhm.
Now, the reason we work on them and continue to go through with them is, well, one, if we have investors, it's for the investors more than anything. But then two, because as you work through them, you're creating value, but sometimes you don't really feel that value, right? Um, and I think that's something that a lot of new investors struggle with, especially on syndication deals. Is a lot of times you don't feel it until you sell it, right? So that, I think that's one of the things that we talk about quite a bit is like, what can I do to realize or feel the the equity that I've made for myself? Um, and I was literally just before this chatting with somebody, and they were asking me this something similar. They were like, what's your guide? Like, how do you decide when you sell? And I'm like, man, it's fluid. It's completely fluid. Depends on the situation, depends on the deal, depends on the deal structure, you name it. Um, but ultimately, what it comes down to me is like, can does the deal as it sits today uh, make an impact on my life and my goals, or do I need to take the equity and deploy it somewhere else in order to impact my life and my goals, right? Um,
Yeah, and one of the things I think that we do take into consideration, not for, I mean, we've done, if you haven't watched the show that we did a couple weeks ago where we were talking about kind of investor metrics, where Tim and I went pretty deep into how we really focus on equity multiple and overall return rather than an IRR basis. But when you're owning and operating deals, an IRR basis investment is very important for a lot of people. And we had a conversation very recently about, well, if we sold it now versus we sold it 6 years from now, what does the IRR look like? And I know that it's the time value of money. And if you look at an absolute dollar return versus an IRR basis, the longer you hold a deal, the idea is that your absolute dollar amount return or equity multiple is going to be higher. But at a certain point in time, your IRR will level out or even start to reduce, and it's entirely possible. So,
yeah,
if some of your this kind of bring after I'm saying it out loud is you got to know you, and we harp this all the time, is you got to know your investor base. What is your investor base most interested in? It? Is it an absolute dollar return? Is it average annual return? Is it cash flow? Or is it an IRR basis? And if your investor basis is mostly interested in an IRR basis, I would take a look at that deal and say, okay, well, every year that we hold this, the IRR doesn't change, but the absolute dollar amount does go up. So what is the good balance of being able to achieve the highest IRR I can for the investors and moving the money into a new deal that will generate the same or more IRR in order to generate more return? I mean, and then also you got to think about you're on a stepped up investment basis. So if you invest 100,000 and you end up walking away with, 135,000 plus whatever the cash flow was over that time period, it's still a good return in a 2-year basis or 2-year period. And now if you take that 135,000 and reinvest it into a new deal, now you're collecting interest on 135,000 instead of 100,000, right? So it all starts to compound, and I'm a big fan of moving money as frequently as possible. And it also is a level of risk, right? You're locking in profits, you're moving the money to a new deal, you're being successful on what you're saying you're going to do for your investors, and there's a lot of value in that too.
Yeah, I mean, I think you said something earlier. And I've been saying this a lot to people lately for a bunch of different reasons, but I'm a big kind of bird in the hand kind of guy.
Mhm.
Um, you know,
I think anybody in today's market is really a bird in the hand kind of guy. I think a year for 2 years from now, people are going to look back at 2023 and 2024 and say that was the low point in the market.
yeah, and I hope you're right. I certainly hope you're right. I
Me
actually
too.
think
For my own
I
personal benefit, I hope so too.
yeah, and I think you're right. I think the one thing that I always give pause to when people ask me about that, they're like, "Yeah, but if you held a little longer," and I'm like, you know, what? Like, if I hold a little longer, then things might improve, things might get worse. That it's
Well, if you apply that to 2020 and 2021 logic or 2022 logic, well,
sure.
if you hold it for another 2 years, you'll be able to sell it for more. Well, no, you wouldn't, because now we're in a downturn.
Yeah. So you don't what I tell people is like I'm like, you don't know, and the other thing too is like, hey, but if we all think we're in towards the bottom right now, right? And I can make a pretty decent return on something I already have and well, to Tim's point earlier, redeploy it into something else that is in the valley
If
right
you're
now.
buying it at the bottom,
Yeah.
your upside over the next 2, 3 years is gonna be significantly higher just because you're not only buying it down low, but you're also doing your value add and hopefully starting to ride it on the way up.
Yeah. I don't, quite frankly, guys, I don't think you'll ever go wrong taking profits and redeploying them. Quite frankly, as long as you're smart about where you redeploy, I wouldn't take profits and redeploy into, I don't know, some highly speculative, high risk activity. But take profits, redeploy into something, especially if you're able to take profits in this market right now, you've done a good job, first of all. Second of all, I don't think you're doing a bad thing. Because you can absolutely take those profits and redeploy them into other deals. And there are deals out there right now, that could potentially give you bigger returns moving forward than leaving your money where it sits.
Mhm.
Um, just to give you an idea, something came across my plate on Friday, which I gave no time to because I didn't have any time. But I had a second to look at it over the weekend, and it's somebody offering a deal with. I mean, it's like 85% seller finance at a very attractive rate. And, you only need like 320 grand to close this thing,
Yeah.
and then you would own it. So, you think about that, like those of us doing syndications, right? Like you think about that, like if you could take some money from a syndication on your equity and you had 320,000 to redeploy, well, you could redeploy it and own something outright yourself. Um,
Yeah, I mean, as a syndicator myself, and I do own, a 24 unit property myself as well. I have to say the highest impact on my life has been that 24 unit property because I own 100% of the cash flow. I mean,
yeah,
that single handedly has changed my financial situation because, like, I mean, that pays for most of my rent and most of my monthly expenses come from that one property. It's like, man, if I could have 2 or 3 of those properties that I own 100% myself, Now it's a way different situation, right? I mean,
Yeah.
the cash flow is different when you're doing it when you own 100% of it.
Yeah.
But okay, but let's be fair. There's a lot of risk that comes up with owning it 100% yourself. There's headaches that come owning it 100% yourself. It is not a passive role. I mean, it's exactly what I do with the syndications, but I just own 100% of it instead of 30% of it. So it's an interesting perspective, but I don't have a preferred return in front of my cash flow. So, when I'm having conversations with the property management company, because we don't I don't self manage that. We don't use Vive Property Management to manage that property. When I have conversations with that management company, my conversation is, hey, post it up on rent, see if you can get an extra $25 or $50. If it sits vacant for a week or two, bring it back down, because I don't want it to sit vacant. I'm not in it to try to maximize the value. I'm in it to maximize the cash flow. By maximizing cash flow is keeping it full. You make money on renewals. You don't make money on your turns.
Yeah. Yeah. And guys, that's a great position to be in, quite honestly, because, 95% of what we operate is in the maximize value category, right?
Right. And velocity to money is all about maximizing value, right? Because you force depreciation, you liquidate, you do it over again, you do it over again, and you do it over again.
Yeah. And guys, don't get me wrong. I love doing it. I love it.
Oh, I know. It's like a drug.
It is. It's like a drug.
But you got to have the balanced portfolio so that you can take those types of risks.
But it's also
your other expenses are taken care of.
It's also time consuming and tiring to do that. It's
God, the stress. Yeah.
It's very time consuming and tiring, and because you got to perform, and you're sitting here and it's like what Vitali's talking about. Think about this for a second. Hey, I want to push on that extra $100 on rent. Oh, but wait a minute. By doing that, I just took a 60-day vacancy. Well, you probably lost in that scenario, right?
Yeah, I lost like $1,500 in cash flow instead of, an extra $100.
Yeah, so it's constantly managing that balancing act, right? And that gets very, very tiring and stressful, as opposed to the other piece that Vitali's talking about is like, hey, just go talk to this tenant and see what it takes to make them stay, right?
Yeah, right.
I want 50. Tenant's like, I'll give you 25, and you're like, okay,
done. Yeah. But it is interesting, and obviously I love moving money around. I really do. I look at that property all the time and I see how much equity I have into it. But then I'm also like, God dang, the cash flow, because the debt is so low. It's, if rates go down to as far as they are saying they go down, maybe I can refinance that property and pull some equity out. But, with rates being high, the only thing I would do is trade out my current debt for new debt at a higher rate. So I literally benefit $0 by refinancing.
And I'm not going to tell people where that property is. I'll let you do it if you want to. But one thing that he's not telling you about this property is that it's also in a unique situation where, by almost doing nothing, Tim may actually see some appreciation on this property by just holding it due to some of the market factors, things going on in the market where this one sits.
Yeah,
there's significant investment.
There's a factory opening up less than a mile away that's bringing 2,700 jobs.
And how many new apartments are being built in that market
0.
right now? Yeah,
no new apartments in the area. So
yeah, so
we'll see.
That's another factor that a lot of times goes into, do you buy or sell? Because that's a situation where Tim owns a property that's cash flowing, paying for itself, putting money in his pocket. Well, let's go to another situation where we have something that it's cash flowing. It's not paying out distributions right now, but it's sitting in a market that has such crazy appreciation and such crazy opportunity that, to be honest with you guys, we've had people come to us and offer to buy that property just for location. And they've offered us what would be a return. It would make money, but we've just looked at them and we've said, no, there's too much upside just to put this thing on stabilized debt and hold it.
Yep.
And I know it's not the ideal deal in the moment, but there's too much upside there.
Speaking of that deal, I had a lot of conversations with investors. And when we originally pitched it as a 10-year development, kind of growth development deal in a high growth market in a wonderful location, And yeah, I mean, it's unfortunate it's not paying out the pref, but everyone's looking at it as like, hey, this was a 10-year investment that we know long term, this spot in this particular major metro area is only going to go up in value. And like a year and a half into ownership, or almost 2 years into ownership, we're already getting, unsolicited offers from developers to buy the land at our exit pro forma. And we're like, wait a
Yeah.
second, like, sure, it's not paying out anything right now because the cash flow is not there. But the equity multiples that we'll see on this deal, if we hold it for another 5 years, rates start to go back more favorable, building starts to start again, land gets more valuable. I mean, maybe we sell this for an extra $2, $3, $4 million just because we held it for an extra 3 to 5 years.
Yeah. Yeah. And it's funny, just to give you an idea of like what the value in this market is. One of those developers came to us a few months ago and was like, hey, I'll pay you. I'm just going to throw out round numbers. He was like, I'll pay you 10 million. I'm like, nah, I don't know. I was like, maybe, I'll look at it or whatever. He came back to us like 2 weeks ago and he's like, so you still entertaining 10? And I was like, really, it's got to have a 12. It's got to be a 12 plus, And he's like, all right, well, I'll take a look. So he didn't walk away, but it tells you.
He didn't balk. Yeah.
Right. So it tells you the market, just tells you the market. Right. And, so that's one of those situations where it's kind of like, man, if that's kind of the feedback I'm getting, then yeah, I'm going to sit on it for a little bit.
Right. And that conversation with the investors are difficult. But if you talk to them about what's happening in the market, what's happening with the unsolicited offers, you say, hey, guys, look, I know that this is not doing the distribution side of the deal. But if we propose that we sell this at this price, which we've gotten, no unbalked for offers at, look how much money you could make. Sure, you're not getting any cash flow, but the equity multiples are far more important than the actual cash flow in this deal. And that's really what the long-term real estate investment is doing in high growth, stabilized areas, high demand areas, right? It's an equity play, not a cash flow play. And everyone's like, wow, you can really sell it for that much. And we're like, and that's what we're getting for it today. Imagine 3 years from now when the market starts to turn around again, insurance rates go back to normal, or at least reduced from where they are now. Interest rates go back, to a more stabilized inflationary target number. It's like now you got way more buying power and more leverage, more buyers in the market. It doesn't really make sense to sell this property today in this day and age in this market because we bought it in the right location for the right price, and long-term optics on that area are just only going to improve.
Yeah. Yeah. No, I completely agree with you.
So the sell conversation to illustrate your point, I mean, just to be abundantly clear here, the sell conversation on every single property is different. And I know when we raise money from these deals, like we have what we think we want to do, and we do an analysis on like where we think it was going to end up, where it could end up, where worst case, where it's going to end up. I mean, we do a lot of analysis in that regard, right? But at the end of the day, things change, markets change, controllables change, uncontrollables change, and we try to make sure that we make the best decision. We're constantly analyzing the portfolio and saying, hey, like what makes sense, what doesn't make sense, how can we benefit everybody in this situation in order to make it the best use of everybody's time.
Right. And so so you have a situation, right, where let's talk syndication. You have a situation where you can sell, let's say you could sell in year 2 and create just call it a 20% IRR. You can give investors a 1.5 equity multiple in 2 years, or you could refi it and pull out, just say 60% of investor capital.
Oh, Tim, you're tugging at my heartstrings there. The analysis I would have to do is with the remaining equity that we have in the deal and the cash flow above the debt service, are we able to service the preferred returns to the investors?
Right.
If you can service the preferred returns to the investors, then the optics probably would be, well, is it going to make sense to refinance this, or is it going to make more sense to sell it? 60% is a really hard number. You picked that one on purpose. My target normally is 80 to 90% or better. Refinancing investor money, because I know that we'll be able to service the debt and the preferred return, and then we as the operating team start to make some cash flow too. So my typical response would be, well, if we can get 80 to 90% back, then probably makes sense to refinance it. If not, we'll probably look at selling it. If we can pull back 100% of the investor cash, there's no doubt in my mind that we're just going to refinance it, because that
Right.
is the best use of investor cash, because you have your equity at play the whole time. You don't create a taxable event. You put that on coupon clipper mode for the next 5 years and kind of forget about it and move your investor equity into the next value add deal and try to do it again.
Yeah.
But it does,
So,
it does. And it's a really good question. You set me up. There wasn't a softball. That was a tough one. 60% of the investor cash being returned at refi. It could go either way. I'd look at opportunity cost. I'd look at what deals we have in the pipeline. I'd look at the IRR. I'd look at the average annual return the investor is going to see, and make a judgment call and be like, hey, we talk to a couple investors, maybe even do a call with all of the investors and kind of lay out some scenarios and let everyone do a silent vote. You can do that on like Zoom. You can do a silent vote if yes, yay or nay or whatever, and see what the general consensus of the population is, and kind of take that into consideration as well. So it's not
yeah.
just hey, we own and operate these deals, we make all the decisions. This is a partnership, like between us and between our investors, and we want what's best for ourselves as well as our investors. And what's good for us is good for the investors, right? So like, I don't want anybody to think that there's any, swayed or biased decision making here, because we all benefit the same by optimizing each opportunity.
Yeah. Yeah. I will tell you, my rough rule here is if you're not hitting that 80 plus number, I'm probably selling and redeploying.
Yeah.
Simply because, if in that scenario, you're hitting a 1.5 over 2, right? So you're
Yeah.
actually ahead of the 2x over 5.
Yep.
So I would pull and go put it in another deal that's doing 5 over 2. I mean, doing 2x over 5, because
Again,
if you do the
right.
math, you're actually ahead.
Way ahead. Yeah. Because
Yeah,
now you're 2xing 150,000 instead of 100,000.
right. And over that same, say, 7-year span, you're actually ahead of the 2x over 5 average, right?
Oh,
So
way ahead.
yeah, so that's the reason I do that. But Tim is right. Like, and I think Nate Barger says it really, really well. The way you truly create wealth in this country is at some point you want to get to buy and hold. You want to start doing burst strategies at some point, right? You want to buy, you want to create value, you want to pull that equity and still own it and redeploy it in something
And
else. And
precisely why I said, if we can return
yeah,
100% of investor capital at the refi, then we'll keep it.
yeah. So you that's where you want to get at some point, right? Is where you're doing that and you're redeploying your initial equity while you still own the property you bought before. And so that is right. If you're able to refi out all the initial capital and redeploy it somewhere else, then that's an easy decision, a very easy decision. So, and quite frankly, I got to be honest, I think there's a lot of folks who sold things in 21 and 22 who are wishing right now that they had done that rather than sell. Because that was a market where you could have easily pulled out your initial capital, held the property.
You got such good leverage with low rates. I mean, your debt coverage ratio would be there. And then you just put it on coupon clipper. Though those same people could have struggled with the rise in insurance costs. And also there's been a lot of taxes that have been
let's hope those people were smart, and when they refied, they put it on stabilized debt. But
to be fair, I mean, some of our properties that we own, the insurance rates doubled and tripled, right?
But you would have had that on a new acquisition too. So
right, exactly. But if you refinanced it at high leverage because of the low rate, and then your costs went up significantly, maybe your debt coverage ratio then drops to a 1.1 or drops below that because of the rise of the insurance.
Now we're making assumptions here. So we're
we're
assuming people were smart when they releveraged, right?
Yes.
So that's something, the old timers in the game will tell you is, hey, like, just because you can pull out 80% doesn't mean you should pull out 80%, right?
Right. Yeah. And that's kind of what I was getting at, was like, if you pull out 80% and you're super high leverage, but then your uncontrollable expenses go up and your You
Yeah.
know, we've seen some decline in rent rates and increase in vacancy and delinquency. I mean, you couple all those things together, and I mean, there is a possibility you could go negative debt coverage ratio,
Sure.
right? You know, so there's something to be said there about not pulling the highest leverage possible. I know that
Right.
the industry standard is to have a 1.25 debt coverage ratio, but maybe you want to give yourself a little bit of cushion there and give yourself a 1.3. I mean, a lot of banks now are doing 1.3 to 1.4, right? So like,
Oh
you
yeah.
know, maybe, you know, I think there's you know, a lot of old timers out there would say, well, I never use anything more than 50% leverage, which I think, you know, is it's to each their own, but there's value there because then you have the cash flow to substantiate any major capex repairs that come up or vacancy issues that you deal with. I mean, the unknown expenses could be astronomical depending on the property age and all that stuff. So, yeah,
Yeah.
a lot of
Good
different
chat.
tools to accomplish a goal, right? And I mean, that's, you know, Tim, you know, in full transparency, Tim and I talk about this all the time. Like we are constantly talking about this because it's a risk assessment, it's an opportunity assessment, it's there's just a lot of variables that have to be considered. And you like to think that you think about them all, but every single time Tim and I talk, I bring up something he didn't think of, or vice versa. I mean, it happens almost every conversation of that's a fair point, or I didn't consider it, or I didn't think about it that way. And it's, you know, there's a lot of conversations that go around these major decisions. You know, so it's why we're talking about it today, right? Because we talk about this stuff so frequently.
Yeah. And it's a talk all the time. I mean, it's constant. Um, which is a good thing, right? Because like, I mean, hell, we were having a conversation this morning. It's like, hey, we have options. Some options are better than others, but it's a
Yep.
conversation to have, and you go through the options.
Yep.
What are we all thinking we're going to do? I don't know.
Right.
What do you want to take on for the next 2, 3, 4, 5 years, right?
Yep.
And so I'd love to tell you, I made a post about this on LinkedIn today. It's the reason the topic came up.
Oh,
Um, and it's always interesting because some folks on LinkedIn are asking me, they're like, well, what's your rule of thumb? I'm like, don't really have a rule of thumb, right? Like it depends on the deal structure. We'll talk about JVs probably a little differently than when we talk about syndications. It depends on how the syndication set up, depends on how the JV set up. If I own it myself, that's a completely different conversation. So it all depends, really.
mhm.
Um, and then also depends on you, right? Like, what are your goals?
Yeah.
To like Tim's talking about, do you have that coupon clipper that makes it so you really don't have to worry about paying your bills every month?
Yeah, that
That
takes a
ma-
load off. I mean, it really takes a mental load off when you know your debt's paid, right? I
yeah,
mean, your mortgage is paid, your car payments are paid, insurance, like all your monthly expenses are paid. That takes a huge, huge load off. And you know, in full disclosure, just recently started paying myself from that property. But you know, before I was like, okay, I'm just going to flip this and get out of it, reinvest 100% of the money, and I did that for 2 years. But now it's like, okay, I'm going to start taking some money out of this because it really kind of makes my decision making processes different on
right.
other assets that we own because this one takes care of most of my bills.
Yeah, because I mean, I'll use I won't share his name, but I know a guy who sold a portfolio that he'd had for a while back when the market was hot and screaming, right? And he made a lot of money, right? He made a lot of money, but then he redeployed it into deals that at the time, high cash flow deals were tough, right? Um,
Hmm.
so he went from a point where like all his bills were paid, he had money to take the family on the vacation and everything, and he had a decent amount of net worth, but he redeployed that capital and the cash flow went away, and now he's like, man, I got a lot of net worth, but my cash flow is gone, right?
Yeah.
So that's something that really makes your life a lot easier sometimes.
Yeah, if that conversation, so we're running out of time here, but if that comment right there kind of piques your interest, I urge you to go back and listen to that investor metrics call that we did. You can find it on Tim or I's personal Facebook pages or LinkedIn or YouTube or whatever. Um, that is why my general rule of thumb is when I'm looking at liquidating an asset, the cash flow needs to say the same on an annual basis, right? On an absolute dollar amount, right? So it's like, if you are able to redeploy your equity into a new deal that keeps your cash flow the same from day one, but has the opportunity to continue to grow into the future, that's a good thing to do. It sounds like this guy liquidated that portfolio and didn't do that analysis of what his actual cash flow is going to be net of debt
No,
service. and made a rash decision based on wanting to grow the balance sheet. But me personally, I would never redeploy the money unless my cash flow stayed the same and then it continued to grow up from there, because then, there's no harm, no foul. If cash flow stays the same, your quality of life and all of that stuff stays the same. And it follows the principle that as your net worth and your equity balances go up, your cash flow will naturally follow. Well, you got to make cognizant, good decisions that you're making investments into deals that keep your cash flow at least the same, but still have the opportunity to continue to grow.
Yeah. Well said. So, all right, folks.
All right, guys. Well, appreciate everybody joining today, and we will see you again next week. Peace.
See you guys.